What is the difference between resident and non-resident local income tax? Imagine you're earning money in one place but living somewhere else. How does that affect the taxes taken from your paycheck? Today, we're breaking down the difference between resident and non-resident local income tax and what it means for your wallet. If you are a resident of a city or state, you pay local income tax on all your income, no matter where it comes from. This means your employer withholds taxes based on your home location's rates. You report your income from all sources on your tax return. Residents often qualify for deductions and credits that can lower their overall taxes. The tax rates are usually progressive, meaning higher earners pay a larger percentage. If you live in a state like California or New York, your paycheck will reflect these higher local taxes. Now, if you work in a different state or city but live elsewhere, you are considered a non-resident for local income tax purposes. You only pay taxes to the place where you work. If that location has a higher tax rate than your home, your employer will withhold at that higher rate. Unfortunately, if you overpay, you won't get a refund on that extra withholding. You are responsible for paying only the non-resident tax from your paycheck. If your home state has an income tax, it may give you a credit for taxes paid to the work location, preventing double taxation. But if you live in a no-tax state and work in a high-tax area, you pay the non-resident tax without any offset. The main differences affect how much money is taken from your paycheck and how you plan your finances. Resident taxes are based on your home location's rates, and you might have more deductions available. Non-resident taxes depend on where you work, and you might pay more if the work location has higher rates. Also, your tax filing process varies. Residents file a standard state or local income tax return, while non-residents file special forms for the income earned in the other jurisdiction. Some places have special taxes called workplace location taxes or non-resident earned income taxes. These are extra taxes on people who work in their borders but live elsewhere. They are separate from state income taxes and can add to your total tax bill. If you move during the year, you might have a dual status situation. You could be a resident part of the year and a non-resident the rest. This means filing to different tax returns for that year. Understanding whether you are a resident or non-resident helps you plan your paycheck better. If you're thinking about moving or taking a new job in another state, comparing the tax rates can save you money. Moving from a high-tax state to a no-tax state can keep more of your earnings in your pocket. Always update your payroll information with your employer when your residency status changes. This way, your withholding stays accurate and you avoid surprises at tax time. Being aware of your local income tax status helps you make smarter financial choices and keeps your paycheck working for you.